Welcome everyone to the Planet MicroCap Showcase 2022. I'm your host, Robert Kraft, and it is my pleasure to introduce our next keynote presentation here at our event. This presentation is titled Portfolio Construction, Canadian Microcap Investing Strategies, and your host for this presentation is Harold Leishman. He's a registered representative at Canaccord Genuity, as well as a partner at the Leishman LeBlanc Catling Group. And with that, Harold, thank you for joining us and take it away.
Bobby, thanks so much for having me. It's always a pleasure and a privilege to be on your show and be able to discuss all things investing, in particular, Canadian microcaps. Today, I'm going to talk about how we build portfolios on the Canadian microcap side. My name is Harold Leishman. I'm a third-generation Canadian venture capitalist. And I've spent almost 30 years investing in the Canadian venture markets. My partner is Michael LeBlanc. He has tremendous depth of experience on building portfolios in a variety of settings. He was responsible for building out Canaccord's Canadian wealth management platform, and that involved interviewing all of the portfolio managers that be available to Canadian brokers, analyzing their processes, understanding what works and what didn't. He ended up being on the investment committee for Canaccord UK's award-winning $50 billion wealth management platform. And so he brings great insights that we like to share with our clients. The disclaimer. Read it quickly, all the fine print. So what we're talking about today is success is when preparation meets opportunity. Thank you, Seneca, for the great quote, or as he said, luck is when preparation meets opportunity. And so what does luck look like? Here's an example of a private placement we did in 2016. It was a 12.5-cent financing. It came with a half warrant at 25 cents. 12 months later, the stock had a huge move and ripped through $1.25 on volume, and the institutions were coming in and putting some money in it at a much higher price. Obviously, not every investment works out this way, but it's worth looking at to see if we can see or determine, what the factors were when we bought in versus when the institutions came in later. By the way, for any U.S. investors that are struggling to have legends removed, feel free to reach out to us. We provide that service to our U.S. clients. It can be a maddening process, but we do know our way through that area. So let's sort of dig in a little bit and go from there. So we have a sort of a multi-tiered approach. We are looking to identify inexpensive, fast-growing companies with cash flow momentum. Ideally, they'd be positive cash flow. From there, we will dig in a little deeper to the companies and track their progress and analyze some of the market data that could be affecting that company. And then finally, we will use sort of some macro strategies and technical indicators to figure out the right timing to try to take a position in said company. So I'll go on and sort of discuss each of these three things in a little more detail. First of all, to identify which companies are perhaps most interesting to find the next 10-bagger or 5-bagger. We screen the Canadian market using a variety of quantitative programs, trying to identify companies that are growing fast. The data here is all fuzzy because that's the way compliance made us put it. But generally, lots of data goes in at the front end, and we are screening for growth. We do put a lot of emphasis on making sure that data sets are complete and accurate. So we can see seasonality or trends in margin expansion compression over multi-year periods. So good quality data is key. From there, we build a master list of companies that sort of meet most of our criteria. We can rank them using a variety of different criteria and come up with some synthesized data sets based on what we're looking for, whether it's fast growth or profitability. And all of this is measured in real time, with live quotes. Key metrics for us. Some of the key metrics, enterprise value to EBITDA or EV sales, margin or margin expansion, and of course, revenue growth. Revenue growth is sort of one of the prime drivers, in my opinion, of outperforming microcap stocks. There's a host of other factors that go into it, but these are sort of our key metrics that we look at. And then from there, we will try to assess the quality of the opportunity. So what's going on in the sector? Is the sector underperforming or outperforming quality of management? Are they focused on cash flow and return on equity or investment, or are they trying to catch a fad? Be all things to all people. Is a company a disruptor in its space? Any risks that we can identify? And from there, we keep sort of narrowing the list down to a smaller and smaller subset. And in terms of timing, there's a lot of factors at play. The graph here, the gray is the total dollar turnover on the venture exchange, which is a great measure of just how much liquidity is in the system for microcaps. One of the prime factors for price movement is where are you in that liquidity cycle? Illiquidity is a prime factor for all of these things, and by many people is deemed to be the biggest risk. Conversely, it could also be the biggest opportunity. You can see up here, most recently in 2021, there was a huge spike and peak in market liquidity. And as most of you know, 2021 was a phenomenal year for gains in the venture market. It wouldn't necessarily be the time that you would want to plow a whole bunch of capital in. Conversely, the example we gave of the financing, 2016 back here was an all-time low, and so your chances of having success should be better if you're buying when there's not a lot of interest in the venture market. So this is just one example of some of the macro that we're looking at. There would also be sector and industry trends that you could lay over that as well. When do you seize opportunity? So here's an example of a stock chart. These are Q4 numbers came out at this point here. You can see the company was generally inexpensive, trading about 1x price to sales and about 6x earnings. Revenue had been growing at about 50%, and EBITDA had gone from negative 800,000 to positive 800,000 over a 12-month period, or a $1.6 million swing. So this is an example of sort of the cash flow or earnings momentum that we're trying to capture. Even with that great news, the stock did not really move right away. It wasn't until their first quarter numbers came out here that the stock started to pick up. And this is the same chart we showed before. We did a financing of 12.5 cents. The company had some debt they had accumulated. We converted that debt to equity. The company then went on and produced another 4 quarters of 50 to 70% revenue growth, coming out of the bottom of the market, and the stock had a very significant run. So a great example of what we're looking for, and how it fits into all of those different factors. They were also an industry disruptor at the time. There was a clear and obvious need for what they were providing. So, and it was a unique sort of a niche product. Full cycle investing on a microcap. Buying is one thing. Knowing when to sell is probably more important. So this is another example of an investment that we made. You can see on the left-hand side, the volume spike. The company put out their second quarter financial results. It was the first quarter of the company being EBITDA positive. Revenues were growing very fast. Stock moved from sort of 10 cents to as high as 25 cents in here, and then trended sideways for about a year. Early 2020, their trailing 12-month EBITDA went positive for the first time, just confirming that that cash flow growth. This was in the face of the COVID sort of meltdown. So valuations were being compressed, but there was plenty of time to build a position. And from there, you can see the stock had a huge run, hit a high of $1.40-ish. Certainly lots of time in and around the dollar mark. And then in terms of when to exit, in here is when they announce their quarterly numbers and the revenue growth rolls over. And from here on in, revenues continue to decline. Company goes from, EBITDA positive to EBITDA negative, and you can see the share price acting accordingly. So the process also gives us signals, not only when to enter, but when to exit. And that's over and above, any sort of portfolio management techniques you might be employing in terms of, trimming gains, to take profit off the table. And that's our presentation. It's short and sweet. Preparation allows you to find opportunity and hopefully have success. And it's simple but effective.